This is the last of our 3 bond cases, and here's the good news. If you understood the discount lesson, you already understand this one. A bond issued at a premium is the exact mirror image of a bond issued at a discount. Every idea we built, the extra interest, the effective interest method, the amortization table, shows up again, just with the signs reversed. So this lesson is really about flipping the discount story over and watching it still work. If you haven't watched the discount lecture, I recommend watching it first. Let's set it up with the opposite situation. This time, our bond promises a stated rate of 12%, but the market is only demanding 10%. Now, our bond is more attractive than what's out there. It pays more than investors could earn elsewhere. So what happens to the price? Investors will compete for a bond that pays above market, and that competition drives up the price. They'll pay more than face for it. That extra they pay above face is what we call a premium. Notice the logic exactly mirrors the discount. There, our rate was too low, so we sold for less. Here, our rate is too generous, so we sell for more. And the consequence flips too. This time, we borrow more than face today, but we only repay the face amount at maturity. We end up repaying less than we borrowed. So in this situation, instead of a rate that's too low, we have a rate that's too generous. Our stated rate sits above the market rate. The result, instead of selling below face, we sell above face, and that higher price pulls the investor's effective return back down to the market rate. And the flip side, instead of paying extra interest, we're effectively paying reduced interest. The premium we collected up front offsets our too high cash payments, so over time our true interest cost comes out lower than the cash we hand over. Here's the takeaway. If a discount was extra interest, a premium is reduced interest. Let's put the 2 accounting moments side by side again, just like we did for the discount. At issuance, we receive more than face. The premium price hits our account, and our liability starts above the face amount. The carrying value begins high, and that excess is the premium. Then, over the bond's life, we pay the stated interest in cash each period, which is generous because our stated rate is above market. But our true expense is lower than that cash payment because we're slowly giving back the premium. So the carrying value falls period by period from the premium price back down to face. We borrowed more than face. We repay only face. The difference reduces our interest cost. That's a premium, start to finish, the exact reverse of a discount. The mechanism in this case is the same effective interest method. Interest expense still equals the carrying value times the market rate. Nothing about that rule changes, only the direction of the result changes. Here's why. You'll recall that the cash interest is based on the stated rate, which is now too high, but the true expense is based on the market rate applied to the carrying value, which is lower. So this time, interest expense is smaller than the cash we pay out every period. The difference between them is the reduced interest we talked about, and it draws down the premium. It gets subtracted from the carrying value, pulling it toward face. And the same conceptual point holds. So let me say it again because it matters. The bondholder doesn't see any of this. They paid a price and they expect to earn the market rate on their investment. No more, no less. They have no idea there's a premium account or an amortization schedule on our books. All of that machinery is just our behind the scenes way of recording that the true cost of this debt is the market rate, even though our cash payments are higher. The amortization table also works the same. It's the same machine running in reverse. Its only job is to take the premium we collected at issuance and spread it across the life of the bond, reducing our interest cost a little each period. Ignore the specific numbers and focus on the patterns in each column. The first column shows our interest payment. Notice how it's the same each time, and it's a function of the stated rate. The second column is our interest expense, the amount that we should be recording as interest based on the market rate, and the amount that we are effectively paying by borrowing more than we have to pay back. Run down the last column of the table and you'll see that the carrying value is falling period after period until it settles exactly on $100,000 at maturity. Same destination as the discount bond, the face amount, just approached from above instead of below. The table allocates the reduced interest so that the premium is fully amortized right as the bond becomes due. Let's do one together. We're going to take bonds with a face value of $1,200 and a stated rate of 8%. Compute their issue price using the lower market rate this time of 5%. Build out an amortization table using the effective interest method, and then record entries for issuance and interest payments. Let's begin by calculating the present value of our two promises using Excel. Remember that the first promise is that we're going to pay semi-annual interest payments every 6 months for 2 years, and the second promise is that we're going to pay back what we borrowed, the face value, at the end of the 2-year period. So to calculate the present value of that, we need the market rate of interest, which is 5%. Also remember that before we get started, whenever we have a semi-annual payment, we need to halve the interest rates and double the periods. So I'm going to halve this interest rate right now. And I'm going to fill out the number of periods by referencing this 2-year and multiplying it by 2 because 2 payments per year for a total of 4 interest payments. Now, what is that payment? We need to take the face value of the bond, $1,200, and multiply it by the stated rate because this is what we contractually agreed to in the bond on the bond indenture, and that is the 8%, which I also need to have because of the semi-annual interest payments. So I'll divide that by 2. So $48. Notice that the amortization schedule has started to fill out, but it's not correct until we finish our present value calculation and get the price of these bonds. So the next thing I need is the future value, which in this case is the future payment I'm going to make at bond maturity, the face value that I'll pay back, $1,200. Finally, I'll do my present value calculation, which in Excel, I just have to hit equals PV and open parenthesis, and it'll tell me right here in the formula what I need to grab, what numbers I need to grab. But I want to remind you that we're doing 2 present value calculations in one formula here. We are taking the present value of an annuity, the interest payment, and we're also taking the present value of a single sum, which is that principal payment at the end of the 2 years. So 2.5% is our rate, market rate. Then we're going to grab the number of periods, 4. Then we'll grab the payment, which I'm going to make negative because it's a cash outflow. And then we will grab the future value, which is the principal payment that we're going to pay in the future. I'll also make that negative. Close that parenthesis, and we've got our bond price of $1,268. So each of these bonds is going to sell for $1,268, even though the face value of the bond is $1,200. And that's because we're promising to pay 8% interest payments, even though the market rate is only 5%. So we're going to sell them for more to offset that 3% difference. We would only like to pay the market rate of interest. To record that bond issuance, I'm going to debit cash, and I'll debit cash for the $1,268 times the 500 bonds. Remember, we have 500 of these bonds, not just one. And I'm always going to skip a line and just go to bonds payable. This is how I like to keep things straight. I know I need to always credit bonds payable for the amount of the face value, the amount that I'm contractually obligated to pay back at the end, no matter what happens with the market rate and the pricing. So here I'm going to credit bonds payable for $1,200 times 500 bonds. Okay, now you can see that there's a difference here between the debits and the credits. We need another credit to balance this out, and that is going to be a credit to premium on bonds payable. Remember, this is a contra liability account. It's basically married to our bonds payable account. The two go hand in hand to tell us what the carrying value of our bond is. Carrying value is another way to say book value. 33,858 becomes our premium on bonds payable. And what that represents is a placeholder to offset our interest expense. Because if I would normally be issuing a bond at par or face value, I would debit interest expense and I would credit cash for every single payment that I made and they would match. But in our case, it's not going to match. I want to debit interest expense for the effective rate, the market rate of 5%. And I have to credit cash with the interest payment for these 500 bonds that's based on the stated rate. So let's record that. So I'm going to debit interest expense. And my amortization table here has figured all of this information out for me. I know that my cash payment every 6 months is $24,000, but my interest expense is calculated like this. I'm going to multiply the market rate of interest times the carrying value of the bond each year, each interest payment, in order to figure out what interest expense should be. Then the difference between the two, because I'm debiting interest expense and crediting cash, is my amortization of that premium. It's the offset. So when I debit interest expense over here, I'm going to debit interest expense for $15,846. But I'm going to credit cash for the higher amount of $24,000. And you'll notice then that I need a debit to balance this out, and that is going to come from my premium on bonds payable account. It's going to be the difference here, which is calculated in my amortization table as $81.54. So I'm effectively going to move some of this premium out of that account, that contra account, and into the interest expense account. But it's going to move into the interest expense account as a credit. So it's going to offset that $24,000 that I would have been debiting to interest expense without this adjustment. So now I'm actually debiting interest expense for $15,846 instead of $24,000. The premium offsets it. Now I can record the second interest payment. with a debit to interest expense again. And again, I'll refer to my amortization table for the numbers. Interest expense is $15,643. And I am going to debit premium on bonds payable as the offset, $83.57, to the cash payment of $24,000. So just taking a look at here at the bonds payable and premium account quickly, these two numbers together represent the carrying value of my bond. And the carrying value of my bond at this point is $617,347. The goal is at the end to have the premium on bonds payable account be empty so that all I have remaining is the bonds payable account at the carrying value of $600, which is equal to face. Because at the end, when I retire this bond and pay back that principal amount of $1,200, I need to just be able to debit bonds payable for $600. I don't want there to be anything remaining in that premium account. I should have amortized or recognized that offset to interest expense over the life of the bond rather than wait till the end. To wrap everything up, remember that when the stated rate is above the market rate, a bond sells at a premium. The premium is reduced interest. We borrow more than face, but repay only the face amount. Under the effective interest method, interest expense equals the carrying value times the market rate, and the amortization table just spreads that reduction across the bond's life. You now have one pricing tool and one effective interest method to handle all three cases. The only thing that ever changes is whether the market rate is below, equal to, or above the stated rate.